Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nishit Jalan from Axis Capital. Thank you, and over to you, sir.
Thank you, Stanford. Welcome to CarTrade Tech 3QFY22 result conference call. From the management, we have Mr. Vinay Vinod Sanghi, Chairman, Managing Director and CEO, Anisha Menon, CFO and Director, and we have Vikram Alba, Chief Strategy Officer. So now I'll hand over the call to Vinay to take you through the presentation and his opening remarks, post which we will start Q&A. Over to you, Vinay.
Thank you, Nishit, and welcome everybody to the call. Sorry we got a little delayed. We had some IT tech login hitch, and sorry for that. But and the clarifications you might need. Vikram, can we go to the next slide, please? The first part is really the auto industry in the last quarter and the last 9 months. As you can see, the first 3 months of the year, in May especially, we had a little bit of a COVID impact, in the industry bounced back for a couple of months. And in the last 3 to 4 months, we'd have what we call a semiconductor impact, right? Which is some shortage of supplies, etc., etc. And as you all would know, even I think, as you said, some of the results of some of the other manufacturers we announced today, the car market has been down by about 15% last quarter. The two-wheeler market also in sales has been down generally in India, which is more demand-driven than supply. But generally, there's been a car supply issue for new cars, and there's been a little bit of sluggish on the two-wheeler side. And last quarter, the auto industry is actually, or the car industry, the two-wheeler industry is degrown. It's been a tough 9 months, I would say, for the car industry. We are pretty glad that during these 9-month phase, we could stay strong, as far as the company is concerned, and continue on our pattern towards growth and margins. Vikram, can you go to the next slide? So even though the industry is degrown over the last 3 months, we've had a 9-month growth, 33% growth in revenue. EBITDA has grown at 30%. EBITDA margin is up to 32% last quarter. We continue to be the number 1 two-wheeler automobile and car and two-wheeler portal in India. Only profitable player, as you all know. Vehicle agnostic, so there's cars, two-wheelers, commercial vehicles. Average monthly unique visitors in Q3 goes to 31 million, which is still, there are 31 million unique customers coming to our platform every month. This is the average for the last quarter, which has grown over the previous year, same quarter. And we'll show you some of that later in the subsequent slides. Organic traffic, which is traffic which is free, shows the robustness of the company and also shows the brand affinity. And part of the reason why we have a margin of 32%, EBITDA margin of 32%, is 86%, which is very, very significant. When you put against 30 million customers, 86% coming organically. Number of vehicles auctioned is all-time high, 1.3 million. For the quarter, for the run rate, so the quarter is over about 300,000. The numbers will come later, but at a rate of 1.3 million a year. So that's grown at highest ever numbers as well. Our revenues have reached 102 crores for the quarter, which is an all-time high as well for the company. EBITDAs are close to 33 or 32.3 crores for the quarter, which is a run rate of almost 130 crores for the year. But we've shot 32 crores for EBITDA. And as I said, EBIT margin has gone to 32%. For this quarter. So, in spite of the auto industry being sluggish, what we found is that revenue growth in the 9 months has been 33%, EBITDA has grown by 30%, and EBITDA margins are 32%. One of the things we've talked about in previous calls is trying to achieve this 30 numbers, right? Which is really growing revenue and EBITDA by 30% or over 30%, and also achieving an EBITDA margin of over 30%, right? It's something we pride ourselves in, is growing profitably. And as you can see here, clearly that over the 9-month period, the company has not only grown, but grown in a profitable manner. Backed on brand affinity, backed on traffic growth, back on number of vehicles being auction growth. So highest ever revenue and 30 in terms of margins, growth of EBITDA as well as revenue growth. So can we go to the next slide, Anisha? You want to take this up, Anisha?
Thanks, Vinay. As mentioned by Vinay in the previous slide, the company has achieved a 33% revenue growth and a 30% adjusted EBITDA growth year on year. Our revenues for 9 months was 253 crores with a 65 crore adjusted EBITDA. For the quarter ended December, we achieved our highest ever quarterly revenue at 102 crores with an adjusted EBITDA of 32 crores, which has resulted in the adjusted EBITDA margin of about 32%. As you can see here, there is an exceptional non-recurring and a non-cash adjustment of 140 crores in the 9 months period for ESOPs that were granted in April 2021. Of these ESOPs that were granted, there were 15 lakh shares which were vested in 1 year. Typically, all our ESOPs are vested over 4 years period, which is why this is an exceptional item. This was vested in 1 year, which has resulted in a one-time non-cash adjustment to the P&L close to 140 crores as on December. As on FY22, for the financial year FY22, we expect this charge to be about 180 crores. Having said that, based on the number of ESOPs that we have granted as on date, we estimate our FY23 charge to be close to 20 crores. Also, if you see here in the numbers for the 9 months where you see 100 crore loss, if you carve out these 140 crores of a non-cash adjustment, you can only, you'll be able to understand what the profits really are, without the non-cash adjustment out here. Vikram, if you could help me with the next slide, please. In slide 5, we have shared the standalone results of CarTrade Tech, which predominantly hosts the consumer group business, that is revenues from our websites Carwale, CarTrade and Bikewale, which are media and lead driven. As you can see here, the revenues have grown by 47%, and the adjusted EBITDA has grown by 56% year on year. The revenues for 9 months were about 110 crores with a 25 crore adjusted EBITDA. And if you look at the Q3 numbers, the adjusted EBITDA margin is at 26%. Vikram, if you could please move on to the next slide. In slide 6, you can see the consolidated results of the remarketing business, which includes our commission or the transaction business as we call it, which is predominantly our auction and the other related businesses. As you can see here, revenues have grown by about 24%. Our adjusted EBITDA has grown by 17% year on year. The revenues for 9 months was 145 crores and the profit for that period was about 40 crores. For the quarter ended December, as you can see here what's circled over here, the adjusted EBITDA margin is about 35%. Vikram, if you could help me with the next slide, please. This talks about our revenue and adjusted EBITDA growth over a period of time. So year-on-year basis, like we mentioned before, the revenues have grown by 33%, our adjusted EBITDA has grown by 30%. Q3 versus Q2, again, the revenues have grown by about 16% and adjusted EBITDA grew by about 32%. Q3 versus Q3, as when I mentioned in this previous slide, I think the industry itself faced tough times where there was a negative 15% growth. However, we witnessed a 19% growth in revenues in Q3 versus Q3. Vikram, if you could help me with the next slide, please. The slide 8 talks about the average monthly unique visitors across our platform. In Q3, we have 31 million customers and we continue to enjoy 86% of this traffic coming to us organically. Vikram, if you could help me with the next slide. These are the Google Trend reports. The Google Trend reiterates our dominance as a brand. With extremely high recall value, we continue to maintain our #1 position in both cars and bikes. The reason our brand is in the #1 position is because we are synonymous to trust, quality and reliability, and we continue to invest in product and technology to deliver a great consumer experience. Vikram, if you could help me with the next slide, please. Slide 9 shows the auction listings for the quarters and it represents the growth. If you look at the Q3 numbers, we had the ever highest listings and which has resulted in a 53% growth as against the Q3 of last year. Over to you, Vinay, if you could take us through the highlights for this quarter.
Yeah, we can go to the next slide, please. I just wanted to give you a little bit of our strategy going forward and a little bit about the highlights for the last quarter. So I think this slide is something we've shown in multiple meets in our results time and even during various other calls. This is really how we think about our company and our business going forward. I think as you all know, we are a platform which with our strengths being the 31 million customers a month which come, the 1.3 million vehicles we auction. But our strengths on the platform are also the tech and the technology and software we have created, which connects and links all stakeholders. So dealers sell vehicles on our platform, dealers buy vehicles on our platform, consumers like you and me, 30 million of them sell vehicles or buy vehicles on our platform. Manufacturers sell vehicles on our platform, banks give loans on our platform, sell vehicles on our platform. So we are really creating an ecosystem with our strengths being the customers we have and the technology and software we have. which connects all the stakeholders. If you look at the strengths of all the consumers we have, right, and you look at the businesses we have, on the left hand, you've got the consumer group, which looks at all the 30 million customers coming there for two-wheelers, cars, used cars, etc., etc. Really, the remarketing group is our business which helps consumers sell vehicles and big businesses sell vehicles to dealers and fleet owners, which is our remarket, which we've shown you in our remarketing results. The consumer group and the remarketing group are really our two core businesses today, which contribute most of our revenues today. And as you know, our revenues are growing at 32% for the first 9 months. And also there's a 32% EBITDA margin on these revenues, right? As these revenues increase, as you've seen over the last few years, our EBITDA margins grow, our EBITDA continues to grow. And these really are profitable businesses. Over the next 3-4 years, we continue to anticipate them to have a similar growth rate over the next few years. But yeah, this is the core businesses, new cars, used cars, and helping consumers sell vehicles today. There are businesses of the future which we are also creating currently. Franchising or our B2C used car business is one of them, right? Franchising or our B2C used car business helps consumers like you and me choose a car online and have it delivered to you. It's giving a seamless, branded used car retailing experience to the customer today to, when he wants to buy a used car. Then the auto finance side. We've built a fintech product on Carvale today, which is at its infancy, where we approve loans for customers like you and me. You can come online, put in your data. We link you with multiple banks today with whom we've deeply integrated so that you can get a loan approved in a few seconds or a few minutes versus days in the real world. And then a software side, all the dealer management solutions and all the things we provide to manufacturers and dealers. And then, of course, as you know, we also want to look at other aspects of the ecosystem, electric vehicles, ownership sharing, connected vehicles, all these new emerging trends. So really look at us as a platform where the core business today is what you're seeing, the consumer group, the remarketing group. What we want to look at the future as well, apart from doing the consumer group and the remarketing group, is really growing our franchising, financing, software services, even things like insurance, car repairs, car servicing. And we're going to do this through activity that you're doing within the company by incubation or acquisition or investments. But really, this is the strategy of the company over a long period of time with a core strength, as I said, using all our customers, 30 million customers, dealers, manufacturers, banks, and using that strength we've got to get into the new areas or adjacencies. It's needless to say, any revenue we add in any of these new businesses or existing businesses adds directly to our profitability and EBITDA, as you can see in our financial results. Very few companies have a 30% growth rate and a 30% EBITDA margin. We are one of those, which is an exception by itself, right? It's very, very rare you find in India a company or an internet company, first of all, having a 30% margin and then growing at over 30%. So we have both those boxes ticked. We want to use that strength and look at growing in the future. Anisha, can you go to the next slide, please? Vikram, can you go to the next slide? This is something we announced a few months ago. As you all know, we're sitting with a lot of cash in the balance sheet. We are one of the few companies which do not do a primary in the IPO because we are sitting with cash in the balance sheet. And we are also generating cash, as you can see in the adjusted EBITDA numbers today, which was 65 crores in the first 6 months. We're generating cash and we have cash in the bank. We have earmarked, our board has allowed us to earmark about 750 crores to make investments and acquisitions in the ecosystem, in businesses like car servicing, car repairs, car financing, electric vehicles, all these new emerging trends and new ideas so that all these 30 million customers can avail of those products and services and we can add to our revenue and profitability as we go on. So there's something created in the last quarter, which I wanted to update all of you with. Vikram, can you go to the next slide? At the core of the company, we're a product digital company. And this slide we showed in the last quarter as well. We are heavily focused on digitizing the automotive ecosystem. So just to give you an example, when you come and buy a car today on Carvale, a new car or used car, you can search your car, find your car, select a car, take the differences between two cars, look at expert reviews, look at what users think about it. Where we are moving more and more towards now on a new car or a used car is helping you go through the journey of actual purchase and actually buying the car itself. So you can book it online. You can get a loan instantly disbursed in a minute to you and you're working with banks on it. You can buy an insurance policy online. You can sell your old car online. You can integrate that entire offer into buying a car, book the car online and have it delivered to you. So really digitizing this entire automobile journey, right from choosing a car, selecting a car, to discovering a car, to getting the car to deliver to you in a complete seamless online manner is something we are working heavily on. Our product teams, technology teams are working and offering this product and services now on Carvale itself to our customers. But we also are working with manufacturers on this. We can go to the next slide. This whole digitization of the automotive system, working heavily with car manufacturers. You may be pleased to announce that you're pleased to hear that we have a tie with one of the leading manufacturers in India, MG, where the auto finance product we have is now available on MG's website, MGs, dealers, etc., etc. So really, our marketplace of financing becomes available, and we build all these technologies for MG Motors as an OEM. MG dealerships as well in India use our dealer management solutions to run their business, the used car dealerships. But what we are really doing here is digitizing the ability of a car customer or a two-wheeler customer to come online on CarVale or BikeVale and buy a car seamlessly and have it delivered to them and have a complete digitized journey in buying the vehicle. But also, we're taking these products and tools and technologies on manufacturer websites, manufacturer dealerships, so that not only on CarVale and BikeVale is this experience seamless, but our finance marketplace and other tools are available across the entire ecosystem in India. So digitizing the auto ecosystem in India is really the vision of the company, the goal in India, and we're making huge progress, through to our 30 million customers as well as manufacturers, dealers, and banks. Vikram, can we go ahead? In this attempt, we talked about this last time as well, is we want to provide a complete online used car buying experience for all our customers. We've already started putting out what we call CarVale certified or CarVale ad-shored outlets. The product here really entails you and me coming online, choosing a used car, getting a warranty from CarVale, getting a money back guarantee from CarVale, booking it online, getting a loan online, and having the car delivered to you. We want to provide that entire what we call one-click used car shopping experience. It's really not available anywhere in the world. So we are really the first ones going out there, getting this done, where you can on one click buy a used car and have it delivered to you. And that's the attempt of CarVale ad-shored. Just go ahead, Vikram. In an attempt to this, we did tell you last quarter, we've expanded this further in this quarter. We've gone to 22 outlets. As you may have seen the press release, we want to take to 200 in the next couple of years. So this is a big area of focus for us. So you can seamlessly come and buy a used car. As we do some of these things, especially on this CarVale ad-shored side, adding transaction revenues. So when you book a CarVale ad-shored certified car online, charge a transaction fee to all the cars being sold there from all our franchisees. So this adds to a new pool for us. We're excited about this whole CarVale ad-shored business, and we believe it's going to be a major growth area or growth driver for revenues and profitability in the next 2 to 3 years for the company. So apart from our used car media revenue, our new car media revenue, and lead revenue, this becomes another source of transaction revenue for us with very little cost because, as I said, there's no marketing cost against this. All these customers already come to our platform. Can we go ahead, Vikram? There's another part from our remarketing group where we're working closely to get more supply to our C2B. We auctioned 1.3 million vehicles. In the last quarter, we also had a tie-up with Ashok Leyland where all the trade-in vehicles coming to Ashok Leyland, when people want to buy new commercial vehicles, the trade-in or the old vehicles, which come in there for trade-in and exchange to Ashok Leyland dealerships and the company, will come to Shriram Auto Mall for auction or sale. And this is a very significant tie-up for us in the commercial vehicle industry, and we feel very positive, about this particular tie-up, which should add to volumes on a commercial vehicle side in our auction business. So we've got tie-up with Ashok Leyland and then also Bharat Benz. So 2 commercial vehicle manufacturers tie-up. I think I want to add here that we actively not only get this one-click purchase or sale of cars or commercial vehicles or vehicles on all our platforms, but also working with car manufacturers, dealers continuously to enable this to all sets of customers. Right? Can we go ahead? This is what we had. I think what we can do now is we can, take your questions and doubts so that, we're able to clarify all the questions you might have.
Thank you very much, sir.
Thank you.
Ladies and gentlemen,
sharing, I think, become maybe easier. Yeah.
Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a questions. And for participants who are logged in on the webcast, you are requested to post your questions via text. We take our first question from the line of Vimal from Union Asset Management. Please go ahead.
Yeah, thank you for the opportunity, sir. Just a basic question. If I were to look at... am I audible, sir?
Yes.
Yeah, thanks. So just a question on basically, if I were to look at your remarketing business, we are currently doing 54 odd crore per quarter. But now if I were to look at the remaining portion of the business, which is about 34 odd crores, and if I were to look at the progress that we've made over the last year, we see a 12% growth in that particular number. Just wanted to get your sense on basically this business will be the business for will be our classified business, right? If I'm not wrong, the B2B B2C business, right? The 34 crore business, which is the remainder from. Basically, I'm just doing a simple calculation from the refinancing minus consolidated number.
No, the standalone numbers were shown. The growth is about 54%. Am I right, Anisha? We can share that slide. I think if that's what you're referring to, we have almost about. Yeah. I think he's saying the remarketing. Vimal, I'll just repeat what you're saying. We can show you the numbers. I think we had highlighted these numbers as well. Yeah.
This is
There's a 47. The standalone is our classified business, which is a 47% growth in revenue.
Yeah.
So what was your question? Sorry.
Yeah. So for that's I mean for the 9 month, I agree. We are at very good. We are at 47% growth. But just checking on a quarterly YY basis, the growth is at 12 odd %. I'm talking of revenue from operations without other income. Just wanted to get your sense as to what are the OEMs thinking on spending on digital advertising or digital classifieds at this point in time. Are the spends actually moving more towards digital? What kind of movement you are seeing over there? And do we have to really put in a lot of effort to defend our market share, because it's a duopolistic kind of a market at this point in time? So if we can just get a sense on that. And the second question is on the same margins for the standalone business. Now, while I talk about margins, these are margins excluding other income. So they are currently at about 10%. So if you can just give your outlook on the margins as to how exactly do you plan to improve them going forward? Yeah.
Sure. One is that the income, as I said, over 9 months is about 43% growth. When you look at Q on Q, last year, one of the things which, and you've seen most of the company results not being announced, one of the challenges of last year to this year comparisons is you had a very strong COVID impact in the first 6 months of the year last year. And a lot of manufacturers and the trade generally had a lot of pent-up demand, which was executed in October, December last year. I think this year we've not had that. It's been more a balanced year by itself. So sometimes when you compare this quarter this year versus last year, it's not fair because last year you really had a pent-up demand of COVID, right? So if a manufacturer didn't spend on advertising for the first 6 months, it increases budget for the next 3 months because they had the ability to do so. This year the spend's been more or less constant. So one way to view numbers is really to look at the 9 month to 9 month period, because you normalized for a normal period rather than a 3 month last year, which was exceptional for everybody just because for 6 months nothing happened. Because the 6 month numbers were really bad, right? Because of last year's COVID. So that's the first part. But I think just to answer your question a little broadly, I think we're seeing manufacturer spend on digital go up. And in spite of the industry degrowing, as you can see, we've grown. So that's the first part of it. So obviously spends toward digital are going up by itself, number one. Number two, we feel very bullish for the next 3-4 years. It's still 13-14% of manufacturers' money and dealers' money spent on digital advertising. As you know, in most global markets, it's close to 40%. So we feel very comfortable that 14 will go to 20 and then 30 and then 40. So we see growth on the classified media side completely. We're not resting here also. As you know, we are working on our full transaction model, which is through Shriram Automall and remarketing, which makes up the bulk of the revenue of the company. But we're also working on that one-click purchase of new cars, used cars, which is adding transaction revenue to the media side. So really here we're betting on the media side to grow, but we're also betting on transaction revenue coming in from AppSure and digitization of the entire auto industry by itself through financing, through insurance, other value-added services over the long term. EBITDA margins here are continuing to grow, right? I think, we look at this 26%, really, it's still over a 9 month period also it's marginally grown. We think, this will continue to grow, and as revenue grows, really this cost escalation here is not likely to be in the same proportion. I feel that very close here, we'll get to that 30% margins as well. Other income has also gone up here a little bit because of the cash in the company. Even if you take it out, the company still, this part of the business still seems to be profitable. Some of our remarketing, although it's a standalone and representation is standalone and consolidated, so all our corporate overheads stay in the standalone and not in the remarketing business. So sometimes, some of our corporate overhead also needs to be allocated to the remarketing business, which will make it more even. It's, so you can't just take out the other income from here. I think the way to view it is really collectively across both business, because some of the costs of corporate are sitting here rather than the remarketing business. I think that's the other way to think about it. But on the whole, I would say, we feel very positive about the manufacturer advertising. We feel confident of bringing transaction revenue here. We feel confident of this 47% growth rate. And we feel good about the EBITDA margins, actually, to be honest. At 47% to have a 47% growth, to have a 26% EBITDA margin is not normally common in India.
Sir, so I do take your point on the classification of overheads. There are just two questions that I had, two clarifications. One is basically, could you just, one is a data point actually. If you could just give me the pure EBITDA margins for the classified business for this quarter and the 9-month period. If you were to
it is here.
Probably
it's here 26% in the classified, in the standalone, right? It's 26%. It's here.
Excluding other income, actually, sir.
Yeah, if you take out the mathematics, as I said, if you take it out, that would be it. But then the corporate overheads are here, right? So it have to be divided across. I think the right way to look at it is, across both businesses, and then look at the EBITDA margin of 32% for the quarter. But we feel pretty bullish that both are going to continue to keep growing.
Right. And just one clarification. Any particular reason why we are including the other income while calculating the EBITDA? Because unless and until there is no material operating income over there, and most of it is sort of financial income, any particular reason why we are sort of including that in calculating our EBITDA?
Vikram, can you go to the previous slide, please? Anisha, you want to take us up?
Yeah, so I'll just reiterate this. Since we do not have any debt in the company, we didn't have any finance cost. So when we had discussed this with the auditors on how we wanted to disclose it and how we have been traditionally disclosing our EBITDA, we've always included the other income because there's no debt in the company. So there's no corresponding finance cost which is there. So those funds are typically the funds which are generated in the business or acquired for expansion. So that was the logic, and we've always included the interest in our EBITDA calculations.
Got it. And ma'am, just one last question from my end. The ESOP cost of 20 crores in FY23, would then the vesting be over by then? And do we expect that?
Just want to clarify
that to continue post FY23?
Let me clarify one thing. Just the first part which he had said, which he had said in the presentation, so I want to clarify. The total ESOP cost, which is 140 crores in 9 months, right? Which would be 180 odd crores for the 12-month period. By March, the 140 will be 180. Next year is likely to be about 20. So you'll have about 160 or the 160 crores the write-off will not exist next year. Is that right, Anisha? You want to just clarify that?
Yes,
that's
absolutely right. Yeah.
Yeah, that 20 crores is going to be there in 23. That is recurring, right?
That will be recurring for a longer period. For next 3 years after that, Anisha, will continue?
Yes, so typically it tapers down the way the accounting is. The first year is the large charge. And since here we have one which is vested within a year. But for next year, if it's 20, it'll taper down, assuming these are the ESOPs that are granted. So whatever we are saying is based on the ESOPs that are granted as on date and the visibility that we have today. So it's absolutely clear your understanding. So you have 185 odd crores for FY22, approximately 20 crores for next year. And it will be either the same or lower the year going forward.
Got it, ma'am. Thank you so much and all the very best.
Thank you.
Thank you. The next question is from the line of Shyam Sundar Sriram from Sundaram Mutual Fund. Please go ahead.
Yeah, hi sir, good evening. This is Shyam from Sundaram. Thanks for taking my question, sir.
Sorry, but
excuse me, this is the operator. I'm sorry to interrupt, sir. So your voice is not very clear. Maybe request you to use your handset, please.
I am using my handset only.
Okay, you may proceed, sir.
Yeah. Like I was saying, in the standalone business, the unique visitor growth on a year-on-year has been just about 3%. And if you look at our revenue from operations year-on-year, is just about 12% YOY. If you can give us some sense of the split between the new vehicle sales, the used vehicle sales, this franchisee model, the software sales that we do, that will really help us understand how the different pillars are moving.
So Vikram,
I didn't get the full question. I couldn't hear the full question. Yeah, Nisha, did you hear it?
I was just repeating the question so that our understanding is right. I think his question is on the consumer group. He's trying to compare two things. One is on the UVs year on year versus the revenue growth year on year. Would that be right, Shyam? And based on that,
unique visitor growth has just been about 3%. Now, if you look at our standalone revenue from operations, that is about 12%.
12%.
Now, we do have different sub-verticals between the new car sales related to OEM media, the OEM media related sales, the dealer sales, used vehicle sales, software services. If you can help us understand how these different sub-verticals are as a percentage of, say, a 9-month revenue, it will really help us understand how the business is progressing.
Sure. I think the first part is that, what we've seen is 30 million customers a month. The advertising revenues or the standalone revenues, as you call it, 47% growth for the first 9 months.
Vinay, I'm not talking about 9 months, Vinay. So I'm talking of the
you're talking about the quarter.
This quarter
right.
is
about 12. Right. Okay. So I think one thing we've seen in this quarter is, as I said, to the previous then, is this quarter to last year, same quarter, is not fully comparable, as I told you, because the first 6 months of last year, we had COVID impact, which was very severe. So a lot of the manufacturers spend more money in the last quarter. So as I said, last year, there was a huge demand or a pent-up demand, which we got the benefit of. This is a normal quarter, as you've not had a similar COVID impact this year. Right? And therefore, we've looked at a 9-month growth number. To be honest, the industry is degrown by 15%, and we've seen a growth in revenue. So, that's how we look at it. The new car industry, in fact, in all our revenue segments, it's been a similar view that there has been a growth for these 3 months. Whether it is the primary driver of revenue in the classified business is new cars and used car media. Software is a very small element of this, but we've really seen a similar growth across all these segments.
So how much is on the 9-month basis? The revenue from operations is about 88.37 crores for the standalone business. How much of that is from the new vehicle sales? How much is that from used vehicle sales, and the rest from software and other services? Can you give that split?
Yeah, I can tell you the larger part is new cars and used car media, software, and is very insignificant. But we don't segmentally, report it because our numbers are not audited in that manner. So we don't report by segment at this point. But the significant driver of that is new cars and used cars media. New cars.
I understand, Vinay. I have a suggestion. If you can provide this improved disclosure, it would really help us understand the business much better, rather than giving a monolithic number where we are not able to really see how the different sub-segments are performing. This is a suggestion from my end. Please take that into consideration.
Thank you for the suggestion. Thank you, Sundar. And we will keep that in mind. Sure.
Yeah. The second question is on the Tamil business. The vehicles auctioned in this quarter has grown 60% on a year-on-year basis. But the sales in the remarketing business has grown 16%, implying a realization per vehicle that has sharply dropped on a year-on-year basis. What is the reason for this? How is the mix of vehicles changed here, or have we cut our commissions or the take rate in this business? If you can give some perspective on that.
Yeah. The revenue over again, as I said, 9 months is about 24% growth. There is a marginal take rate decrease, and Vikram, can you put up the Samil's remarketing numbers, please? So I'll explain, Mr. Sundar. Yeah. The remarketing, right? If you see, there is a 24% growth in revenue, and EBITDA margin for the quarter, Sundar, is 35%. There is a little bit of take rate decrease. The take rate decrease is primarily because more and more is moving to only online. We had a more of phygital business, physical plus online. And because of COVID, it has moved a little bit to an more online method. And therefore, there's a slight decrease in take rate. We believe, honestly, that this is the right take rate. But even at this take rate, Sundar, what I want to explain to you is that there's a 35% EBITDA margin in the company. So we feel very comfortable with this margin at 35%. On a 61 crore revenue, there's a 21 crore EBITDA. So we feel pretty comfortable about for the quarter, and of course for 9 months is 144 and 40. We feel pretty comfortable with the margins and this take rate. We believe that this is the current take rate, considering we're moving more and more to a digital world in this business.
So, if you are moving more and more to a digital world, I would presume your other expenses should have been largely under control. But what I do see is that the other expenses this quarter in the remarketing business at 20 crores has grown 45% year on year as compared to the top line growth of 16%. Why have the other expenses grown despite the business moving more to digital, which would imply lower overhead for the business per se?
Yeah, it's a very good question. Actually, what happened when you compare, first is whether you compare in any numbers in a COVID period, 3 months, a quarter, or you compare 9 months. If you compare 3 months, it's 27%, as you can see. If you compare 9 months, if you compare 9 months, it's 27%, as you can see in the numbers here. If you compare 3 months, it's a little higher, and that's because if you've seen last year, during COVID, there were really no increments. So the entire last year went with very low costs, and most of the increment cycle for most companies in India have been in April this year. And not only have we given increments this year, we have somewhat given a little higher increment to make up for the loss of last year for employees. So that has been one big factor. Also during the last year, marketing costs, etc., extremely low, just because having COVID and the reason to advertise or the reason to spend money or the rate at which we're spending money was very low. I think that has changed this year. Sundar, it's a very good point, all these points, and I would say the way to view it is not a quarter by quarter comparison, is to view 9 months and 9 months, because it just averages numbers out, number one. And number two, to view it on quarter 21 individually. The 35% growth rate, the expense as they are, this is likely to be the trend, is what I'm asking, is what I'm saying. The 35% margin, the employee benefits, what they are, the other expenses. Last year, quarter October, December 2020 was an aberration, just because costs were not increased because of no increments, etc. And there was pent-up demand of revenue. It was a very odd quarter just because of what happened the 6 months prior to that.
Sure, then one last question.
Excuse me, this is the operator. I'm sorry to interrupt. Mr. Shah may be requested to come back in the queue for a follow-up, please.
Yeah, no problem.
Thank you. I now hand the conference over to Mr. Nishit Jalan to take up the chat questions.
Thank you, operator. So we have some questions which have come online on the chat box side. So first question is from Sachin Dixit of JM Financials, and even Garima has a kind of similar question. Garima from Kotak. So their question is,
hi Sachin, hi Garima.
The question is, can you provide some transaction metrics and monetization model for AppSure? In terms of details, they're looking at how many cars are you selling via the platform, and how many partner dealers do you have? What is the dealer universe you can target with this model?
Sure. I think I'll take the first one. We have 23 partners right now, as the presentation showed. We're in 18 cities. We've rolled out really quickly. As I said, we want to get to 200, in next year and a half, 2 years. We have a team aggressively working on this with an independent CEO, and we're very bullish about the whole AppSure side. Our model of monetization there, as you know, is transactions of the sales of vehicles from those franchise stores. We charge a take rate on the selling price. Take rate today is quite healthy, and our margins, on it, range from, depending what services we provide, from 1.5% to almost 3% of the vehicle, depending on what service we provide to the dealer. But we feel very confident, about the business and the value proposition it provides to the customer more than everything else. I think our confidence comes from the fact that consumers looking to buy cars, can select a car online and seamless experience to a used car and getting all the back guarantee and warranty, etc., with it. So it's a transaction model. We're charging dealers a take rate fee on the vehicle. Anisha, you want to add something here?
Okay, thanks, Vinay. Vinay, we have a second question again from Sachin Dixit. Have you shortlisted any particular auto tech verticals for investments? Is there anything in pipeline?
So we keep looking at transactions, obviously at an appropriate time when we find something which fits synergies for all our 30 million customers and the product services we offer in those companies. We'll be happy to, announce it. And we are actively looking at all the services I told you, like value-added services to car servicing, to new age technologies. But we have to find the perfect fit. We've had a good track record of acquisition in the past. If you've seen, we've done 3, but all the ones we did turned out to be really successful for the company. So we are a little more choosy, a little more selective, and but we like to find the right ones so that we can make successes out of them.
And I have 2 more questions from Garima from Kotak. One, what is the quantum of loans processed via financing platform? That is the first question. Second question is, how is Google Trends data, user data, different from the ones provided by different websites like a SimilarWeb, Comscore, or App-Annie?
Sure. The loans we provide on our platform. So what we do is all these millions of customers who come to buy new cars, used cars, or two-wheelers on our platform get connected to 9 banks. They get them an approvals on our platform. So the approval comes back to the customer based on his creditworthiness, and creditworthiness is established by his income statement or his credit score. And banks have an algorithm which they use to approve these customers. I can't give exact, but in tens of thousands. We have one of the larger approver of loans for these banks on our platform for new cars, used cars, and bikes. That's one. The other question, and as I said, this platform is very early. It's going to grow into leaps and bounds the next few years in terms of approvals and loans dispersed to customers. The second, and it really provides value to that one-click buying experience to our car customer, which is what we're all attempting at: getting a car online, buying it online, getting a loan online. Right? We're working deeply with these banks to even disburse the loan online, and that's taking its own time. The second question was, how is Google Trends different from SimilarWeb and the others? The way we understand it, the Google Trend is a brand affinity score, which basically means how many people put in Car Wale into a browser versus another brand, let's say ABC brand. So it's a brand affinity score which shows search popularity basically. SimilarWeb and Comscore and others seem to be more total traffic kind of scores, right? So one is total traffic and one is a brand score, a brand traffic score.
Thank you. One more question, a last question from the chat on site.
Sure.
And this is from 2-3 participants that we have got. It's slightly over the medium term. It says, how do you see your revenue growth over the next 3 years? And can you comment on your EBITDA margins in terms of sustainability and improvement going ahead? That would be very helpful.
Yeah, for this quarter, we've had a 32% EBITDA margin, and over the 9 months we've had over a 30% revenue growth rate. Ideally, good companies across the world, tech companies like ours or companies like ours, platform companies like ours, would like to achieve a 30% growth rate over the next few years. So we feel pretty confident that between 25 to 30% growth rate over the next few years is what we'd like to do per year. And we're working hard towards that organically to keep chipping away in an industry, as you know, which is degrown. We still continue to grow and trying to target this 25-30% growth rate over the next few years. Hopefully, if the car market grows and things work out, we should be able to get there. If we do that, our EBITDA margins, which last quarter 32%, is only going to grow, right? I think the nature of our revenues and the nature of our business is such that, the high margin businesses, right? So if you're able to get to our revenue growth numbers, which is what we internally keep striving for, and you've seen, this 32% growth rate over a 9-month period. If you can get to this consistently, as I say, 30 companies, right? Companies that grow at 25-30% and have margin of more than 30% are the ones which are healthy, right? So we'd like to keep this 25-30% growth rate if we can, and over long periods of time if we can, and the margins will 32% will take care of itself or go up even further.
Sure, thanks, Vinay. Vinay, I think we are just running out of time. Maybe we will take one last question from an audio participant. Operator, over to you, and after that, maybe we can end the call.
Sure. Thank you, sir. Ladies and gentlemen, we take the last question from the line of Surya Narayanan from DSP Investment Managers. Please go ahead.
Hi, Surya.
Yeah, hi, Vinay. So 2 questions. So first question, like you mentioned, in this quarter, when we're looking at the standalone numbers, your revenues excluding other income has grown at 12%. And you mentioned that this is in the context of auto sales and auto industry, which is down about 15%. So is this differential a result of you gaining market share, or have industry players, OEMs, continue to maintain their ad intensity despite the sales loss? I mean, how would you just attribute this gap between your growth versus the auto industry's growth?
Yeah, it's a good question. I think the first clarification again I want to make, Surya, is that quarter by quarter is not very comparable, just because last year we had a COVID pent-up demand and this year you don't have.
Sure, but just in terms of if you can comment about what you're seeing within your business in terms of ad intensity by OEMs.
Hello.
Yeah, now we are.
Yes, Vinay, you're audible.
I think we've gained market share as well as because we've seen car sales grown, so I think we probably gained market share. What we feel. Can you hear me?
Okay, understood. Yeah, you're audible. Yes. My second question pertaining to your other income, so that's up fairly strongly quarter on quarter. Any comments on that?
Is it garbage? Anisha, did it come clearly or not really? I don't know.
Surya, your question is from last year this quarter versus this year this quarter?
No, I'm talking about quarter on quarter, the other income trend.
Correct, which is from last year to this year, right? Because from December to September, there is not much of change.
I'm talking about the number which is 135, right? This quarter versus last quarter was 105.
Vikram, if you don't mind, could you just put up the slide quickly? For the consolidated, yes, you're right.
So my question is, what is that growth led by?
Is it?
I think there's some problem with the line. Maybe I can take it offline. That's fine.
Yes, I'm just going to confirm the question. You're asking 13.5 versus 10.5, right? Those are the two numbers you're comparing?
Correct, Anisha.
Right. So Vikram, if you could just come down 2 slides. So on the standalone basis, if you could just come down once. So the standalone is kind of flat because there is no increase on account of treasury income or the other income as we call it. Vikram, if you could go a slide below.
Yeah, hello.
There, the jump that you see of about 2.9 to 3 crores is in the remarketing business, which has some other operational related revenues out there. So that is not treasury related, Surya. I mean, these are on mutual fund kind of gains. I guess
Understood.
That was the question.
Understood. Okay.
Yeah. Thank you.
Yes, that's right. All right. Thank you, Anisha. Thanks, Vinay. Bye.
Yeah.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments.
Yeah, I just want to thank all of you being patient and joining in and trying to hear our story. I just want to again reiterate, with the industry in the last 9 months, and especially in the last 4 months seeing a little bit of a downturn, we still feel committed and feel confident that, with 32% growth in revenue and a 30% growth in 30% EBITDA margin and a 30% growth in profitability, this whole 30-30-30 syndrome, we feel pretty confident about our place in the industry, both on the new car side and the used car side. We also feel we've got a strong platform where we can use all our strengths of brand and technology and, of course, even the cash reserve sitting with us and look at expanding in new areas of business and feel pretty good about the future where we can grow not only our revenues and profit, but our current organic remarketing and consumer businesses, but also, in new areas of business through acquisitions and investment. So just want to thank you for joining in and look forward to seeing you all again soon. Thank you. Bye-bye.
Thank you, everyone.
Thank you very much. Ladies and gentlemen, on behalf of Axis Capital Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.